Welcome to Introduction to Farm and Ranch Taxes.
Hi, I'm Poppy Davis. I teach a class in agricultural taxation at the University of Arkansas School of Law LL.M program in agricultural and food law. I'm the primary author of these materials in close collaboration with my friend and colleague Winona Doris. Winona is a business skills consultant and trainer who works with farmers, ranchers, and fishers. She leads training on accounting, taxation, insurance, and cash flow at both the state and national level. Winona comes to agriculture through familial ties from her great uncle, Ed Scott, who was a successful claimant in the Pigford case against the USDA. Winona holds a BA in economics and accounting, a master's in business administration, a graduate master's certificate in taxation, and is licensed as an insurance agent and a tax preparer.
And it's my pleasure to introduce my friend and colleague, Poppy Davis. Poppy is a consultant and business skills advisor to agricultural and food and beverage enterprises and to nonprofits and local governments. She has worked as a CPA and at the United States Department of Agriculture and in various nonprofits. She holds a Juris Doctorate from Drake University Law School, a master's in journalism from Georgetown, and a BS in agricultural economics from the University of California at Davis.
The LL.M program in agricultural and food law at the University of Arkansas School of Law has been a leader in agricultural and food law for more than 40 years. It has nationally recognized faculty, specially designed courses, on-campus and distance options, and for more information, you are encouraged to go to the website.
This presentation is intended to provide general information on agricultural income tax issues and should not be construed as providing legal advice. It should not be cited or relied upon as legal authority. State laws vary and no attempt is made to discuss state-specific laws. For advice on how these issues might apply to your individual situation, consult an attorney. This project and materials created by Poppy Davis as part of the LL.M program of agricultural and food law at the University of Arkansas School of Law is part of the Agricultural Finance, Tax, and Asset Protection Program.
The Ag Financial Tax and Asset Protection Program has resources to enhance farmers, ranchers, educators, and others' ability to understand and navigate business tax and asset protection decisions.
There are a total of 5 lessons in this series.
For each lesson, there's a short questionnaire to help you decide if the lesson is right for you. Each lesson also includes a PowerPoint, a recording of the PowerPoint, and a PDF file with detailed supplemental information, including the presenter's script, additional topics for discussion and engagement, and additional resources. Hi, everyone. Let's get started with lesson 1.
This is lesson 1 in our series, Federal Income Tax Filing Requirements.
The basic filing requirements are easy to understand, but if you are just beginning your operation or not yet profitable, it may be challenging to figure out how to apply the rules to your situation.
This presentation covers individual federal income taxes only. We are not discussing other federal income taxes such as corporate, payroll, or estate tax. We will not cover state income taxes, but since state income tax is often calculated with the federal income tax return as a starting place, this presentation may help you with the state income tax filing requirements. This presentation also does not cover property taxes or sales tax, which are generally assessed at the state or local level.
The requirement to file an income tax return is different from the requirement to pay income tax. You may have to file even though you do not owe tax. IRS Chart 8 in the Form 1040 instructions shows filing thresholds. You may choose to file even if you are not required to, if you have had federal income tax withheld, and if you're due a refund, or if you're eligible to claim the earned income credit, or if you're eligible for other credits, or to report business losses.
You can go to the IRS website for more information on how to determine your filing status. The important thing to understand is this: even if your business does not generate a profit, you still may be required to file a tax return in order to report your gross business income. Gross income is your income before any deductions for expenses. There are several situations where even though you're not required to file, it is to your benefit to file.
In general, Native Americans have the same income tax filing requirements as anyone else, but there is a special exemption related to income derived from the land. This exemption is only applicable to enrolled members of federally recognized tribes and only with respect to income derived from lands that were put into trust under an act of Congress that specifically exempted income from the land from taxation, or lands that are subject to a treaty which has been interpreted to include language exempting income derived from the land from taxation. Note that if your operation takes place on land with multiple owners or allottees, those people may have rights to a proportional share of net income from activities on that land. Operators in this position should consider a written rent agreement or creating a partnership, LLC, or other business entity to clarify how the primary operators will be compensated for their time and management, and how owners will be compensated for their participation in the business. See also When is Tribal Farm and Ranch Income Exempt from Federal Taxes, a publication from Utah State Rural Tax Education. The links to these resources are in the supplemental resources attached to this presentation.
Special rule: in addition to the general requirements explained in Chart A, you must also file a tax return if you had net earnings from self-employment of $400 or more. Note, special employment income may be earned directly by you or your spouse, or it may pass through to you from a partnership or an S corporation. Partnerships, including LLCs taxed as partnerships, and S corporations are required to file their own tax returns, but they do not pay income tax. The tax returns these entities file report total income and expenses to the IRS. These returns include a K-1, which is like a W-2. It reports each owner's share of income and expense to the IRS and to the owners. The owners use the K-1 from the entity return to report their share of income on their individual tax return. The owners calculate and tax owed when they file their individual income tax returns, and any taxes that are owed are due with the individual tax return. This means that you might have to file a tax return on your small farm or ranch business, even if you have gross income well below the amounts listed in IRS Form 1040 Instructions Chart A. Partnerships, including LLCs taxed as partnerships and S corporations, must file a tax return every year they are in business, regardless of income. A single member LLC owned by two legally married spouses in a community property state does not have to file a separate tax return. For more information, see IRS Form 8832 and instructions.
The IRS requires taxpayers to report on all income from whatever source derived. Individuals may be able to take various deductions to reduce the income on which they are taxed, but they must report all the income they receive. Gross income for a farmer or a rancher typically includes wages, interest, dividends, sales price of an asset sold, and gross income from any business, including the farm business or other Schedule C businesses. Business gross receipts, which are not reduced by any deductions, are reported on Schedule C, line 7, or on Schedule F, line 9. Schedule C for non-farm businesses, Schedule F for farm businesses. Other sources of gross income include pension and retirement distribution, spousal support, gambling winnings, debt forgiveness, prizes, and scholarships.
If your gross income is close to the thresholds in Chart A, then you would have to determine if adding the $300 gross farm sales means you would have to file. If you have a loss and you have other income, it generally benefits you to file. More on this in a minute. If federal income tax was withheld, the person will want to file anyway to receive a refund. This is why it is important to understand the difference between gross and net. Your net farm or ranch income may be 0 or less, and combined with other income, you may fall below the filing threshold. But the rule is you must look at gross farm or ranch income, that is farm or ranch income before any deductions. And if that amount exceeds the filing thresholds, you must file. Yes, because your gross receipts are more than the threshold, you must file, even though you will have a farm loss and will not owe tax.
So understanding the filing due date, filed means received by the United States Post Office prior to midnight on the due date. You may choose to ask the post office for a proof of mailing receipt. If you drop your return off in a United States Postal Service mailbox, be sure to check the time of the pickup. An extension is an extension of time in which to file. It is not an extension of time in which to pay. When you file an extension, you are supposed to pay any amounts due or estimated amount due with the extension request. If you file a request for an extension of time to file and fail to pay what is due by the original unextended due date, you will avoid late filing penalties, but you will still owe late payment penalties. We'll discuss this more in a minute.
If 2/3, 66 2/3%, or more of your gross revenue from all sources is agricultural or fishing income related to producing unprocessed agricultural products or unprocessed fishing catch, then you may elect not to pay quarterly estimated taxes and instead either pay all of your estimated tax by the 15th day after the end of your tax year, which is generally January 15th, or file your taxes and pay all taxes due by the first day of the third month after the end of your tax year, generally March 1st.
If you do not meet the 2/3 gross income requirement, you are required to pay estimated taxes if you expect to owe $1,000 or more when you file your returns. We will take a deeper dive on the definition of agricultural income in Lesson 6. Spoiler alert, agricultural income does not include income from selling value-added products or from agritourism. You can also get more information on this topic at ruraltax.org.
An extension of time to file your return does not grant you an extension of time to pay your taxes.
Note that in some disaster situations, the IRS may make an automatic extension for everyone in the county.
If you do not file on time, The failure to file penalty is 5% of the unpaid taxes for each month or part of each month that a tax return is late, filed after the due date or extended due date, up to a maximum of 25% of your unpaid taxes.
Interest compounds daily, so amounts grow fast.
If you do not pay on time, including if you file on time but do not pay your taxes, the failure to pay penalty is 0.5%, half a percent, of the tax owed after the due date for each month, or for each part of each month the tax returns are unpaid, up to 25% of the total amount owed.
Again, interest compounds daily, so the amounts grow very quickly. All right, on failure to file, generally the IRS can audit for 3 years after the date you file your returns. For substantial understatements of income, they can audit for 6 years after you file your return. But if you never file a return, they can audit as far back as they want to find unreported income. On failure to pay, penalties and interest on amounts compound daily, and the IRS may place a lien on your property. This means that if you sell the property, the IRS automatically takes what you owe them from the proceeds of the sale. The IRS may levy your assets. That means they may take the money out of your bank account or order your employer to send most of your paycheck to the IRS. This is also called a wage garnishment.
If your tax return is incorrect in a manner that results in an understatement of tax by the greater of $5,000 or 10% of the correct tax, you may be liable for negligence and accuracy penalties of up to 20% of the tax owed. Willful failure to file or pay involves knowingly filing a false return or actively hiding money or assets in order to evade IRS actions. Willful failure to file or pay is tax fraud, which is subject up to $100,000 and 5 years in prison.
So the question is, were you required to file? If you were required to file, then you should file. The other question is, would you have owed tax? If you would have owed tax, then you should file. Another question to ask is, would you have received a refund or an earned income tax credit payment if you had filed? If so, you must file within 3 years of the original due date in order to claim your refund or credit. The statute of limitations on audits and assessing additional tax remains open indefinitely if the taxpayer fails to file a return or files a false or fraudulent return. As long as the taxpayer has filed a return which is not false or fraudulent, the statute of limitations begins running when the return is filed. Note that's when it's filed, not when it's due.
For general matters, the IRS must audit within 3 years. If there has been substantial, 25% or more, understatement of income, the IRS has 6 years to audit. The statute of limitations for collections is 10 years from when the tax was assessed.
So question here is, did you build or purchase business assets? Those include an orchard, barn, tractors, fences, anything like that. Did you build or purchase business assets during that time? If so, special rules apply.
Or did you pay income tax in those years? If you can show that you were engaged in a legitimate business with the intent to profit, you can amend the prior 3 years, and your farm losses will reduce your other income, resulting in lower total taxes.
In a minute, we will discuss the special rules for assets and the special rules for how to establish that you have a legitimate business profit motive.
Form 1040 is a summary of many forms and schedules. The face of the 1040 shows wages and other income on line 8. You see Schedule 1. Schedule 1 shows additional detail, including where you show the net total from Schedule C and Schedule F. There are many kinds of income: wages, interest, dividends, income from sales of assets, net income from business, etc. All of those are totaled to come to the total amount of taxable income. So if any of those numbers are negative, that negative reduces your total taxable income. If you have wage income, W-2 from a job, and farm losses, your farm losses reduce your wage income and you still owe less taxes.
The IRS is as concerned with limiting the losses you can take as they are with ensuring you report all of your income. Generally, losses offset income and reduce taxes. There are many complex rules limiting how you may use losses to offset income. Losses may be limited, suspended, disallowed, carried forward, and carried back. These are all advanced tax topics. If you have tax losses and other taxable income, you should consult a knowledgeable tax preparer.
For more information on special rules related to business losses, consult a tax professional or see IRS Form 461 and instructions and publication 925, passive activities and at-risk rules.
Your farm or ranch income or loss may affect your ability to access the Earned Income Tax Credit. The Earned Income Tax Credit goes up as earned income goes up, and then past a certain amount of income, it goes down as income continues to go up. The Earned Income Tax Credit is fairly limited for people with no dependents, but with one dependent, it is often between $1,000 and $3,000, and for 2 to 3 dependents, it is often between $2,000 and $6,000.
The tables are included in the instructions to Form 1040 after the income tax tables towards the end of the instructions. On the 2022 instructions to the 1040, the Earned Income Tax Credit tables start on page 46. Generally, to claim a refund, you must file an amended return within 3 years of the due date of the original return or within 2 years from the date you paid the tax, whichever is later. If you're filing an amended return to report and pay additional taxes, you may file at any time. If you are filing an amended return to establish basis in assets, additional rules apply.
You may file an amended return to make a correction showing more taxes are owed, or to make a correction showing that less taxes are owed, and you may file an amended return to claim the Earned Income Tax Credit.
For more information on depreciable assets and non-depreciable land improvements, see Lesson 6 and Publication 225.
So you should always file a tax return to report the purchase of depreciable assets and to claim the depreciation deduction.
Depreciable assets are things that have lasting value to the business and have an ascertainable useful life in excess of 1 year.
Assets are not expensed, which means deducted, when purchased. Instead, you take a depreciation deduction using special forms that are part of your tax return.
Buildings, trees, vines, fences, equipment, etc. are all depreciable assets.
So what is an ascertainable useful life? It means you know the asset will not last forever, and it can be determined if the asset is still useful or functional. Land has no ascertainable useful life because presumably land goes on forever, and that is why land cannot be depreciated.
Assets are not expensed or deducted when purchased. Instead, you take a depreciation deduction for a partial amount of the asset value each year over the tax life of the asset. In some cases, you can take special bonus depreciation and depreciate the full value of the asset in the same year you buy it, but you still need to report it on your tax return using the special forms dedicated to assets and depreciation.
If you have not filed tax returns and reported asset purchases and depreciation deductions, you may amend going back 3 years to claim depreciation deductions. For items going back longer than 3 years, you cannot amend to claim the deductions. However, when you sell the assets, the IRS will tax you as if you had claimed the depreciation deduction.
We will discuss assets and depreciation again in lesson 2. For more information on how to report assets and depreciation, see publication 225.
Always file to report purchase or sale of assets. When you sell an asset, you pay tax on the gain, which is the sales price less your basis in the asset.
Your basis in the asset is acquisition basis, less depreciation allowed or allowable. Acquisition basis is either purchase price, or for gifts, the tax basis of the person who gave the gift, or for inherited items, the fair market value of the date at the date of death of the decedent, the individual who died and left you the asset.
Depreciation allowed is the depreciation you actually reported on a tax return. Depreciation allowable is depreciation you could have taken on a tax return had you filed one.
But if you do not file a tax return and take the depreciation deductions to which you are entitled, later, when you sell the asset, your tax will be calculated as if you took the depreciation deduction.
Generally, you should file tax returns to take depreciation deductions, even if doing so creates losses. We will discuss specific rules on farm losses in a few minutes.
In order for expenses to be deductible, the expenses must relate to a trade or business that is functioning when the expenses were incurred. Well, how is that determined?
Facts and circumstances must indicate activities beyond exploration and research, activities which are directly related to generating a profit.
The first $5,000 of startup expenses may be deducted in the first year of business. All other startup expenses may be deducted over 15 years, beginning in the year that the business becomes operational.
If you use assets during the startup phase of your business, you can file a tax return to record the depreciation, but also show that the depreciation is part of startup expenses, which will later be amortized. You will need a CPA to help you do this correctly.
When does farming and ranching activity begin? When does the startup period end for a farmer or rancher? For annual crops, the first day of the first year you plant a crop, which will be harvested within 12 months.
For livestock, the first day of the first year you hold an animal that is intended for sale, or the first day of the first year you hold an animal that is intended to be used in breeding animals, which you intend to hold for sale.
For permanent crops, there are special rules related to what must be capitalized and what may be expensed. These rules are closely related to the rules for startup costs. We will cover permanent crops in a later lesson.
For more information on livestock and permanent crops, it's beyond the scope of this presentation, but will be covered in later presentations. Please see Pub 225 for more information.
In order for expenses to be deductible, the expenses must relate to a trade or business, not a hobby or recreational activity. Well, how is that determined? The taxpayer must be able to demonstrate that they have a legitimate intent to profit.
Profit in this case means either annual profits, which are sales in excess of expenses, or the long-term appreciation of assets. That means that assets will later be sold for an amount in excess of costs.
Things that will never meet this test: gardening, growing food for a food bank, growing food to give away, landscaping to maintain or improve the value of your personal residence, keeping animals or livestock for pleasure or to maintain your personal residence.
If you falsely claim that an activity is a business for the purpose of reducing the income taxes you owe or increasing your earned income tax credit, that is a form of tax fraud. This is why the IRS will likely question your fundamental business profit motive if they audit a tax return that shows farm losses or an income tax credit that was increased by farm income or loss.
The IRS will look at all facts and circumstances. At a minimum, you should be able to show
a plausible plan for generating income that has to involve some form of sale.
That you keep ordinary and necessary business records and you use them to make business management decisions.
That you respond to losses by making changes to the operation.
Or that you have and continue to acquire the knowledge appropriate to the needs of the business.
See Pub 225 and ruraltax.org for more information on this topic.
So what are things you do for your farm or ranch that for sure you would not do for a hobby? What are things that you do that would demonstrate to the IRS that you have a genuine profit motive? Attending this class is one thing for sure, right?
The hobby loss rule says that if you lose money in 3 out of 5 years, then you must be able to demonstrate with evidence that you have a legitimate intent to profit.
It is incorrect to state that if you lose money 3 out of 5 years, you are a hobby. Many businesses lose money in 3 out of 5 years.
Normally, the IRS must assume that if you file a business tax return, so that would be a Schedule C or a Schedule F, you are a legitimate business. That means the burden of proof is on the IRS to prove that you did not have a legitimate business. But if you lose money in 3 out of 5 years, that flips. The burden of proof shifts from the IRS to you, and now you have to be the one to prove your legitimate intent to profit.
It is common for people to have an incorrect understanding of this rule, but now you know the real rule. If you have a legitimate business and can demonstrate your legitimate intent to profit, you should not hesitate to file Schedule F and take your farm losses against other income.
We'll see you at the next lesson.
You can see IRS Publication 225, the Farmer's Tax Guide, or go to ruraltax.org or the IRS website and publications for more information. Thank you.